So there's a few concerns that I've found that most Canadian physicians have to deal with. Number one is that they have a delayed earnings schedule, meaning that they have to put in years to decades worth of work and school to finally earn the reward of all of their hard work. Number two is that when they do finally get that payday, they have to deal with large levels of student debt that they have to try to pay off. And number three, while they're trying to pay off that debt, they also have to deal with one of the strongest financial psychological forces known to man, and that's called lifestyle inflation, aka their expenses go up as their income goes up. Now, obviously, these are all concerns that physicians just try to deal with by making more money. However, if there is one concern that stands as the crux of all evil in a doctor's life, especially because of its ability to truly erode and limit your wealth potential, it's taxes. And of course, a lot of people would consider this a champagne problem. You know, the only reason why you have to pay a lot of taxes is because you've made a lot of money. However, why on earth would you want to pay a large tax bill, especially if there's a few strategies that you can implement to significantly reduce the amount that you have to pay to Uncle Sam? And the good news is that's exactly what we're going to go through today in this video. What is going on, you guys? If you are new here, my name is Aaron. I'm a certified financial planner, independent wealth advisor, and university instructor where I teach personal finance. And over the course of the past 6 years, I've helped high-performing Canadians and physicians just like you become the wealthiest versions of themselves. And I wholeheartedly believe that my number one way of being able to do that has been by significantly reducing their tax bill by implementing a combination of the 5 strategies that we're going to go through today in this video. And just a precursor here, a lot of these strategies are complex and nuanced in nature, especially as I get further in the video. And my purpose for this video is to simply keep things high level and as simple as possible, with the goal of planting seeds for you to be able to take away and potentially explore implementing in your own real life. So the first strategy that you can use to save thousands on taxes is to incorporate your medical practice. Now, you've probably heard of this, whether it's in medical school or from your colleagues, but I'm going to try to keep it as simple as possible. So incorporating means basically like creating this separate entity that you will own and work for, and every dollar that you make will be paid to this entity. And because you are an employee, you can specify a dollar amount that you will pay yourself from this entity. Now, there's a lot of benefits to incorporating. Number one is this idea of limited liability, meaning that if someone sues you, they actually sue this entity that is your corporation, and that liability doesn't extend to you or your family or anything personally that you own. Now, unfortunately, this limited liability doesn't fully extend to professional corporations, which is what your medical practice is going to be. So this isn't all that much of a benefit to you. Number two is taking advantage of the lifetime capital gains exemption. So basically that means when you go and down the road, you sell your business, a significant portion of the proceeds of that sale, as of the time of this recording, it's $1.25 million, can be received completely tax-free. But the fact is, most doctors and physicians don't really sell their business. They kind of just hold on to this corporation to fund their lifestyles right up until they pass away. So this benefit isn't as necessarily valuable to you either. And number three is the fact that corporate tax rates are much lower than personal tax rates. Simply put, every dollar earned by this corporate entity is going to be taxed at a much lower rate than if you were to earn that dollar personally. Now this, unlike the other two benefits, is very relevant to you, and it actually is probably the biggest reason as to why a physician would incorporate. So let me walk you through an example here using a Dr. Shauna Williams. She is a 35-year-old successful rural family doctor earning $400,000 a year in her medical practice, and she lives in BC. Now, Shauna is not incorporated, so at this level of income, she's at a very high tax rate, and she pays about $170,000 a year in taxes, which leaves her with $230,000 in her pocket net after taxes. Now, she only needs $150,000 to live on to fund her personal lifestyle, which leaves her with about $80,000 a year to invest in her future, which is great, right? But let's just say Shauna watches this video and at the beginning of the year decides to get incorporated, and she earns the exact same amount of money this year, $400,000. Now, since she only needs $150,000 to live on, she would have to pay herself $228,000 out of this medical corporation to her personally to net $150,000 after taxes. Now, the rest of the money that's inside of her corporation, she actually only has to pay 11% in taxes, which actually leaves $153,000 left inside of the corporation for her to invest in her future. This is almost double of what she'd be able to save towards her future if she wasn't incorporated. So if we look at who this strategy is best suited for, simply put, it's someone who is earning significantly more than they need to live on. Now, obviously this depends from person to person, but the starting threshold that I define as significantly more is $50,000, meaning that if you are earning at least $50,000 more than what you need to live on, you might want to consider incorporating. Anything less than this threshold, the costs start to outweigh the benefits, especially because the ongoing administrative costs might tend to run high, and also there are some other tax saving tools like the RRSP that you can use to bring down that tax bill as well. This being said, this probably wouldn't work for someone who has high personal lifestyle costs, or if they're trying to pay down their student debt or mortgage debt quite aggressively. The second strategy that you can use as a Canadian physician to save thousands in taxes is known as income splitting, which basically means you are sharing household income with family members like your spouse or children who are in presumably much lower tax brackets. This means that less of your income is going to be taxed at your higher tax bracket, and instead you can pay family members who are helping you out in your medical practice a reasonable salary so that the overall household average tax rate is actually going to come down. If you're incorporated, you can also look to set up what's called a family trust so that you can distribute dividends instead of a salary towards different members of the household. However, there's a lot of complexities and rules around this, especially around splitting income, that I won't get into this video. However, it's something that you can explore down the road, especially if these people in your family are helping you out with your medical practice. So to illustrate an example, let's go back to Dr. Williams and her husband, Jose. Now, remember, Dr. Williams and her family needs about $150,000 to live on, meaning that she needs to pay herself about $228,000 from this entity that is her medical corporation to net the $150,000. That means she'd have to pay about $78,000 in personal tax. However, let's just say Jose helps his wife out around the clinic with some maintenance, some paperwork, and some administrative work, and Dr. Williams pays Jose about a $65,000 salary, which would net Jose about $50,000 after taxes in BC. This means that Shauna would actually only need to pay herself $140,000 to net $100,000, which combined with Jose's net after-tax income equals the $150,000 they need to live on in their household. Based on this, Shauna has paid $40,000 in taxes, Jose has paid $15,000 in taxes, equaling $65,000 in taxes, which is actually $13,000 less than the $78,000 that Shauna would have had to pay in personal taxes if she only paid herself from her corporation. So who is this for? Now, obviously income splitting seems really great, but there's a couple of very important caveats here that actually makes this legit. The main thing is that if you're going to go this route of trying to split income with other members who have lower tax rates in your family, it is absolutely crucial that they're actually actively working in your medical practice. Now, they don't need to be a doctor or a physician doing actual medical work, but they need to be providing actual value to the business that would yield a salary of that amount. And that brings me to my second point. The amount and the salary that you pay them actually needs to be reasonable. Like if Shauna decided to pay Jose a six-figure salary for filing paperwork an hour a week, that wouldn't be on side with the CRA. All right, moving along, the third strategy to save thousands on taxes for Canadian physicians is implementing an individual pension plan. An individual pension plan, aka an IPP, is a type of retirement plan that works extremely well for incorporated physicians. And without getting into the weeds, basically the biggest benefit of an IPP is that it allows an incorporated physician to contribute far more towards retirement into a tax-deductible, tax-deferred account than they they would if they had just invested and contributed to a conventional RRSP, which is also a tax-deferred, tax-deductible account. However, an RRSP is capped in terms of the amount of money that a physician or anyone can put in there in any given year. Now, just like the name indicates, an individual pension plan is very similar to a regular pension plan where contributions are made and then you get a future retirement income that is predictable based on the number of years that you have worked and the amount of salary that you've taken over those years from your corporation. The nice thing is that any contribution that's made to the IPP is considered tax deductible to the corporation, which reduces the corporate tax liability, and any growth on the investments that's inside of that IPP is actually going to be tax deferred. You don't have to pay tax on that until you withdraw the money from the IPP in retirement. Another bonus is that because it's supposed to be acting more like a pension plan rather than a regular investment account, there's a certain amount of money that needs to go into this IPP, and there's a certain amount of growth that needs to be achieved by the IPP every single year to be able to actually give you that predictable future retirement income that you kind of actually know right when you start the IPP. And anytime there's a shortfall in this performance where that predictable income might be compromised, you as a physician, well, your corporation actually gets to make another contribution as a top-up, which is also going to be tax deductible. So let's run through an example with our Dr. Shauna Williams again. So let's just say she's further on progressed in her career. She's 45 years old now, and she's starting to think about retirement. She's heard of the RRSP before, and based on her current room, she can contribute $100,000 today to max out her RRSP, and then every year from here on out till retirement, she can do the maximum contribution limit, which is $32,500. So by doing this, assuming a 6% growth on her investments inside of the RRSP, she would have roughly $1.587 million at retirement. So let's just say she watches this video, she's heard of an IPP, and she talks to her accountant and advisor. And based on her age, the amount of years that she has worked, and the salary that she's paid herself every single year, she can make an initial contribution of $175,000 plus an annual contribution of $50,000 to this individual pension plan that she sets up. And based on this, at the age of 65, assuming the exact same 6% growth, she would have over $2.5 million inside of the IPP at retirement. This difference is an extra $922,000 available for retirement savings. Plus, on top of this, the growth on this extra $18,000 inside of the IPP is going to be tax deferred, as opposed to if the $18,000 was invested inside of her corporation. This, if you run the math and compare the growth of that extra $18,000 or so in a 6% tax deferred vehicle versus, let's say, a 4% non-tax deferred vehicle, that would lead to a total tax savings of over $140,000. So if we think about who this is for, it would really boil down to three characteristics. Number one, because the calculation for the amount of money that you can put into the IPP is based on the number of years of service that you've had in your medical practice, it only starts to make mathematical sense after the age of 40. This is the point in time where you've accumulated enough IPP room where the contributions start to actually outweigh the maximum contributions of the RRSP. Prior to that, you're probably just better off utilizing the RRSP. Secondly, this only works for an incorporated physician who has more surplus income inside of the corporation than the RRSP maximum contribution room in that given year. If Shauna was only making $30K more than what she needed, she would be better off to avoid all the administrative and setup costs of an IPP and just invested to max out her RRSP. And thirdly, because the calculation of how much can go into the individual pension plan is based on the years of service worked and then your earnings, your salary over the course of those years, you need to have actually had paid yourself a salary, okay? So there's a lot of physicians who get to the point where they start to hear about or they think about an IPP, but all they've done over the course of the years is paid themselves a dividend. And then when you come to look at the calculation, they have no IPP room built up. So that's just something very important to consider, especially if you're before that, age of 40, to continually pay yourself a salary to generate this IPP room that you can use in the future. Now, moving along to our third strategy, which I see a lot of physicians actually overlook, it's the idea of maximizing your personal registered accounts even though you have a corporation. I see a lot of doctors put a lot of energy and focus on maximizing their corporation, which, it makes sense. Why would you want to pay all those personal taxes to get the money that you don't need personally out of your corporation? But the problem is that any money that's left inside of the corporation and invested, any growth on those investments they're taxed quite unfavorably, anywhere from, a 30 to a 50% tax on the growth of those investments. However, your personal RRSP and TFSA has a lot of benefits in comparison to the corporation. Main ones being that any growth on the investments inside of your personal RRSP is completely tax deferred, and any sort of growth and withdrawals on your personal TFSA is completely tax-free. So let's go back to Shauna to run through an example here to show you what this actually looks like. So remember, she's got about $153,000 of unused income that's left inside of her corporation to invest. Now, let's just say she invests all of that and she's able to generate a 6% rate of return. The unfortunate thing is that any sort of return that she generates on this corporate investment account is actually taxed quite unfavorably. This is based on a set of rules that the CRA implemented to make sure that, business owners don't hoard just a bunch of money inside of their corporation. So let's just say based on what she's invested in and how much of those taxes she can recover through different mechanisms, her actual rate of return, net after tax, that she can achieve on these corporate investments is going to be 4%, meaning that her effective tax rate inside of the corporation in those investments is 33% on the growth. She does nothing else other than put this $153,000 into this account every single year. At 65, she would roughly have a balance of $8.58 million. Now, in reality, it's not as simple as that, and I'll get into that in just a little bit. But let's just say instead of doing this $153,000 a year into this corporate investment account, at the end of every year, she pulls out about $32,000 to max out her RRSP every single year. Now, I know what you might be thinking. You're like, Aaron, isn't she going to have to pay, these exuberant taxes on this $32,000? Remember, any contribution made to the RRSP is considered tax deductible. So if she takes it out of the corporation as a bonus, yes, she would be deemed taxes on that. However, if she takes that $32,000 and invests it into her RRSP, the net tax effect on that $32,000 is actually a wash. So she takes this $32,000, puts it in her RRSP, that creates a deduction, meaning zero taxes on that $32,000. She does this for the next 30 years and then invested in the exact same investments that would yield a full 6% rate of return. Remember, because it's tax deferred. In 30 years' time, her RRSP balance would be roughly $2.529 million. However, she's still investing the remaining balance that she has left inside of her corporation in the corporate investment account. So $153K minus the $32K withdrawal to put into her RRSP leaves her with about $121,000 to invest inside of that corporate investment account. And now this $121 invested into that corporate investment account is going to be taxed, and then the net rate of return it's going to achieve on the corporate investment account is going to be that 4%. So in 30 years' time, she would roughly have $6.786 million inside of her corporation, which combined with her personal RRSP, she's looking at a balance total for retirement savings of over $9.3 million, which is going to be an extra $735,000 available at retirement compared to if she just left all of this money inside of her corporation and invested it. Now, I will be the first person to say that this was an oversimplified example of corporate investing that was illustrated just to state a point. There's a lot more complexities and nuances and tax regulations around leaving money inside of your corporation and investing it as a physician. And there's probably one that I just want to outline in terms of important things to think about, and it's this idea of corporate bloat. So what the heck is corporate bloat and when does this happen? So you know how I mentioned earlier that any sort of surplus surplus income that's left inside of your corporation that you don't need for personal lifestyle or expenses is taxed at a much lower rate. In the case of Dr. Shauna Williams in BC, any money that's left inside of her corporation is taxed at that 11%. The thing is, that 11%, known as the small business rate, only applies to the first $500,000 of surplus income that's left inside the business after expenses. Let's call that the small business pool. And any dollar of surplus income in any year beyond this $500,000 is actually taxed at 27%. That's called the general rate. And here's the thing that is super crucial to know that'll impact you. Any dollar of passive income earned inside of a corporation beyond $50,000 of passive income actually decreases the size of that small business pool by $5. I really hope I didn't lose you there, so I'm going to try to illustrate this with an example. Let's just say after a few years, Shauna has built up about $2 million inside of her corporation in an investment portfolio. And then the following year, she earns $60,000 of passive income from that portfolio, which actually is not that unreasonable. This is above that $50,000 threshold by about $10,000. So what's going to happen here is that the amount of income that Shauna can earn as surplus income after her salary, after expenses, and still be taxed at that 11% rate is actually going to decrease by $50,000. Meaning any income that Shauna earns from being a doctor that's left over inside of the corporation beyond that $450,000 mark is going to be taxed at the general 27% rate instead of the small business 11% rate. So in our example, the amount of money that Shauna was earning and leaving in her corporation, about $153,000, isn't really close to that $450,000 new threshold, but you can see how this could become a problem further down the road as her investment portfolio inside of the corporation continues to grow and continues to produce more and more passive income. If a few years progress along and now her investment portfolio is not $2 million, but $5 million, and that year the passive income that's generated by that portfolio is $150,000, that's $100,000 more than that $50,000 limit. $100,000 multiplied by $5 has effectively reduced that small business pool by the full $500,000 that she started with at the beginning of her career, meaning that every single dollar that she earns and is left over inside of the corporation is going to be taxed at the general 27% rate instead of that 11% rate. Now, I hope that makes sense, and I hope I didn't lose you in the weeds there, but in reality, the mechanics are quite complex, but the strategy and the idea behind it is actually fairly simple. The more money that we can move out of that corporation into your personal registered accounts, the more we're able to limit the amount of corporate bloat that ends up happening inside of the corporation. And the nice thing is by investing into those personal accounts, you're actually retaining a lot of those benefits when it comes to tax deferred investing. And now our last, but definitely not least, final tax strategy to help physicians save thousands of dollars in taxes is the idea of corporately owned life insurance. Now, I know I might be wading into some deep or skeptical waters here, but in reality, as a financial planner, it is very difficult to have a tax mitigation or a tax planning strategy for incorporated professionals or incorporated physicians without discussing insurance. And look, I know a lot of people who have a serious distaste for insurance, and that may lead you to click off this video right now. And to be honest, I don't blame you. This is something that was literally sold door to door, and the insurance industry seems to have pretty much let anyone with a pulse in who can pass a 90-minute long exam. And unfortunately, the financial planning and really good insurance professionals who do an amazing job, especially in the realm of tax planning, they're the ones who get besmirched in all of this, especially with the recent advent of social media and everyone on TikTok and Instagram pushing this idea of like these random strategies like infinite banking, which personally I do not believe is an appropriate use for permanent life insurance. In reality, life insurance has two major benefits when owned and held inside of a professional corporation. Number one is that the death benefit of the policy is paid out to the beneficiary of that policy completely tax-free. And number two, the majority of this benefit can be allocated to something called a capital dividend account, which is basically just a notional account that can be claimed and paid out to the shareholders or a shareholder's estate at any given time completely tax-free. Basically, that's a complicated way of saying that the majority of the death benefit that comes from an insurance policy can leave and come out of the corporation completely tax-free. And without getting into the weeds, let's keep the explanation there and go back to Shauna. So let's just say at retirement, Shauna has $5 million sitting inside of her corporation invested in a portfolio of stocks and bonds. And based on her and Jose's retirement needs, they take out about $250,000 a year from this corporation to fund their retirement lifestyle. And the rest will just stay inside of the corporation, continuing growing at the net after-tax rate of return, as we said, at 4%. And let's just say they live another 20 years to the age of 85. At age 85, they're looking at $3.2 million still sitting in the corporation. The problem is that once they pass away, their kids or next of kin is going to have to deal with paying a tax bill equal to anywhere from 50 to 65% of what's left in this account, which will erode a lot of the value that Shauna spent her entire life building up. But let's just say she had a corporately owned life insurance policy that she purchased after speaking with a good accountant, insurance advisor, and financial planner, and this policy cost $50,000 a year, and that would yield a death benefit at the age of 85 equivalent to $2 million. So now when Shauna and Jose pass away, this $2 million will be paid out tax-free to the corporation, and then the majority of that $2 million will come out tax-free to the next of kin or kids through this capital dividend account that I mentioned earlier. And then they could use that to pay any sort of taxes due on the estate for Shauna and Jose. And that being said, the tax liability would actually be less as well because she spent more of her money in that corporation, and by moving $50,000 into an insurance policy every year to yield that $2 million payout. Now, insurance is a whole different beast and conversation in itself, especially when you think about the different types of insurance or the different cash values that can build up inside of insurance policies. And I won't get into the details on that, but if you want to see another video where I go more deeper into insurance, hit that like button or comment a question down below, and I'd be happy to make up a video in the future. However, it is important to understand the characteristics of who this strategy specifically is for. Number one, there's an actual need for insurance, okay? Throwing a bunch of money inside of an insurance policy, having this value build up, which in the future you can go and use as collateral to get a bank loan personally, completely tax-free so that you can go and buy a dishwasher or a car, is not a need for insurance. That's literally just an oversold scam. Number two, there's a clear indication of surplus and excess capital that's left inside of the corporation that you do not need for your own personal lifestyle or retirement expenses. And number three, you actually have a desire to be a steward, to leave a legacy to the next of kin or a cause that you deeply care about. You know, Shauna and Jose might have a $1.5 million tax bill at death, and they may not care because they don't particularly have a next of kin or kids or a cause that they deeply care to pass the money on to. Just because you can get rid of a tax bill, it doesn't mean you have to, especially if you do not understand or if you're not comfortable with the complexities of insurance planning. Well, there you have it, guys. I know that was a lot of information. If you stuck around this long, I truly want to thank you. I hope you guys learned something today, and if you are able to implement either one or a combination of a multiple of these strategies, that it's going to be able to reduce your tax bill over the course of your successful careers in front of you. And if you're a physician or if you know a physician, I highly encourage you to send this video over to them if you found some value, because if you don't have the right team of professionals in place, it may end up costing you thousands of dollars in taxes or missed opportunities. So as always, I highly encourage you to consult your tax professional and financial advisor about any one of these strategies here. And if you want to gain more personal finance insights and tips for high-performing Canadians just like you, hit that subscribe button, and I will see you in the next video.